Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Marvell stock so we can determine if it's a buy or a sell. Marvell develops and produces semiconductors. Their largest segment is semiconductors for data centers. It sells 40% of its products in China. The company is headquartered in Wilmington, Delaware, and was founded in 1995. Let's get started with the model. This is a large cap company, 56 billion market cap. They're trading at $66 a share, and they have 859 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had $700 million of free cash flow in 2021, dropping to $630 million in 2022. They had over $1 billion for the first time in 2023, and a little over $1 billion in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that is negative every single year. I'll show you their income statement in a little bit so we can really understand it better. Revenue is a sales for the company, and that looks really good, growing from $3 billion to $4.5 billion, then jumping up to nearly $6 billion. It did detract a little bit in the trailing 12 months to $5.8 billion. They have completed their 2023 fiscal accounting period. Their 2023 fiscal year started in February 1st, 2022, ended January 31st, 2023. So they just recently completed their first quarter of 2024, and that ended April 30th, 2023. If that sounds confusing, leave a comment and I can explain further. This is their income statement for the last 8 quarters. The most recent quarter that ended 4/29/2023 had revenue of $1.3 billion. Let me show you a breakdown of that revenue. Of the $1.3 billion, 1/3 of the revenue is in data centers, 27% in enterprise networking, 22% in carrier infrastructure, 11% in consumer, and 7% in automotive. Their data center revenue peaked in the first quarter of 2023 at 44%. Their enterprise networking peaked this quarter at 27%. Same thing with carrier infrastructure, that peaked this quarter at 22%. Consumer peaked in the first quarter of 2021 at 16%. Automotive is the highest this quarter and last quarter at 7%. But their total revenue is actually down when you compare it to the first quarter of 2023. Their revenue peaked in the third quarter of 2023 at over $1.5 billion. They also had over $1.5 billion in the second quarter of 2023. Now it's $1.3 billion. Their revenue hasn't been this low since the third quarter of 2022. And the big dollar amount drop is in data centers. It peaked at $640 million. Now it's only $440 million. And in case you didn't know, they're fabless, like NVIDIA, which means they design the semiconductor chips, but have someone else manufacture it. The biggest foundry in the world, the company that manufactures the semiconductor chips, is Taiwan Semiconductor. Intel is a fabless and a foundry. They design and manufacture chips. You see how well that's doing for them. They've been getting killed the past few decades. They used to be the king of semiconductors. Now they've fallen far down on the list. Of the $1.3 billion of revenue, 39% is in China, 14% US, 8% Singapore, 7% Malaysia, 6% Finland, 4% Taiwan, 3% Thailand, 3% Japan, 1% Philippines, and 15% all other countries. In the same quarter last year, they had $644 million of revenue in China. That dropped a lot to $516 million. That's why they had lower revenue this quarter, because of China. China was 45% of their business, now it's 39%. Revenue in the US went up about $38 million. Revenue in Singapore more than doubled. Revenue in Finland more than doubled. Revenue went down more than 50% in Thailand. It went down a lot in Japan as well. And Philippines took a major hit. It was 4% of their revenue last year, now it's only 1%. So it seems like in most Asian countries, revenue is down a lot. In Europe and North America, revenue is up. It is up in Taiwan, which is an Asian country, but most Asian countries, like Thailand and China, it's down a lot. 67% of their revenue are sales directly to the end user, directly to the customer, people like me and you. 1/3 is to distributors. So the margins are much higher direct to customer. Usually it's hard to scale direct to customer. It's much easier to sell to distributors and have them do all the work. And revenue is down in both categories year over year. It was getting close to 1 billion direct to consumers, now it's under 900 million. And distributors is down a little bit. Let's go back to their income statement. So the top line of the income statement is the revenue. We just looked at that a lot. 1.3 billion in the latest quarter. Cost of revenue, all the expenses directly related to generating the revenue, that was 765 million, which is higher than prior quarters, even though they had lower revenue, so their margins are getting worse. Gross profit of 557 million. It hasn't been this low since the quarter that ended July 2021. For example, look how close their revenue is in this quarter, 1.34 billion compared to 1.32 billion. You'd expect their COGS to be similar, but it's a lot higher now. It's over 100 million higher, 656 million compared to 764 million. If you search cost of goods sold in their most recent 10Q, they compare the current quarter to the same quarter in 2022. COGS is up 10%, but gross profit is down 26%. Their COGS as a percent of revenue was 58%. Last year was 48%. Their expenses are getting really high. So of course they have lower gross profit, 557 million compared to 751 million, and their margins are only 42% compared to 52%. In their 10Q, they're comparing this quarter, you can see the 557 million here, 557 million, to this quarter. You can see the 750 million here, the 750 million here. They say the reason COGS increased is mainly due to a shift in product mix and increased inventory reserves. So they have a lot more inventory on their balance sheet. As a result, gross margin decreased by 9.7 percentage points, from 51.9 to 42.2. Then they have operating expenses. They have their highest R&D ever at 481 million. Selling, general, and administrative costs is lower than prior quarters. It's under 200 million. It was over 200 million in every other quarter, at least the past 7 quarters. Restructuring charges, this is related to acquisitions, that was 60 million. So operating expenses are a lot higher than gross profit. So they have an operating loss. Before this quarter, they had 5 straight quarters of operating profit. The last time they had an operating loss was the quarter that ended October 2021, a loss of 33 million. They received 2.5 million of interest on their investments. They paid 53 million of interest on their debt. That's the highest ever. About 50% higher than 2 years ago. They have a loss of 230 million before taxes. So they receive a tax credit of 63 million. Their net loss is 169 million, which is a loss per share of 20 cents. A lot worse than last quarter of a loss of 2 cents. And when you compare it to the same quarter last year, it was a gain of 1 cent. They do increase their shares outstanding each quarter. It's the highest ever, 857 million. Here's their operating section on their statement of cash flows. And the purpose of operating cash flow is to convert net income or net loss into cash. You can see they had positive operating cash flow the past 8 quarters, even though they had a net loss of 169 million. Because the way you calculate operating cash flow, you start with your net loss, then you have to add back the non-cash items on the income statement. We add back 78 million of depreciation and amortization, 143 million of stock-based compensation, 270 million of amortization of intangible assets. Then we have to adjust for changes in working capital. They had a cash inflow of 191 million from accounts receivables. That means they extended credit in a previous quarter. They sold products but didn't receive payment for them. And now this quarter, those customers are paying for those products. They had a cash outflow of 105 million in accounts payable. That means they bought something on credit in the previous quarter and are paying for it in this quarter. So their operating cash flow in the first quarter of 2024 is 208 million. Last year was 331 million. Last quarter was 351 million. In the past 8 quarters, this is the second worst operating cash flow. The worst was the quarter in April 2022, where they have operating cash flow of 195 million. Let's look at the capital structure. 15 billion of equity, $5 billion of debt. They're 77% equity, 23% debt. Their net debt is $3.6 billion. That means they have $1 billion of cash on their balance sheet. I gave them a WACC, a weighted average cost of capital, of 9.5%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $40 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $35 billion. We divide that by 859 million shares. And we get a calculated stock price of $40. They're trading at $66, so they're trading at a 62% premium. It's a sell according to the model. I think I was generous with their future free cash flow growth. In the trailing 12 months, it's only $1 billion. And I have them at $1.6 billion in 2024, growing to $2.7 billion by 2027. Even with my lenient model, the stock still seems really overvalued. Simply Wall Street's valuation is 43. They're also saying the stock is overvalued, 54% overvalued. 25 analysts priced this stock and the average price target is 63, the lowest 49, the highest 100. Another 30 analysts priced this stock and the average price target is 66. So they're saying the stock is pretty much worth trading at. This is where the stock has been trading since they IPO'd. So it looks like they IPO'd around $13 right before the dot-com crash. A few months after it IPO'd, it doubled, and then it really came down to maybe $3, $4 because it wasn't a proven company at this point. And lots of people were losing money in 2001, 2002. So they weren't willing to invest in a company like this. But it did really well from 2001 to 2006. It ran up to about $35. And if you bought it in 2006 at 35, you'd have to wait about 14, 15 years to get back up to $35. Like most semiconductor stocks, it did really well post-COVID. It ran up to nearly $90. It did come down to below 40, but you can see it really shot up last week when Nvidia released their earnings, and they said they could have over $11 billion of revenue next quarter, mainly due to AI. So this stock does seem overvalued, but not nearly as overvalued as Nvidia does. This stock does seem overvalued, but not nearly as overvalued as Nvidia stock is. They pay a really tiny dividend each quarter, only 6 cents, which is a yield of 0.37%, 20% of their free cash flow. There are 62 companies in the same industry as Marvell, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend that much on CapEx, since they're fabless. They spend more than the median, less than the average. Of course, Taiwan Semiconductor spends the most because they're the largest foundry in the world. For every dollar of debt, they have 30 cents of equity. They pay a really small dividend. They do generate more free cash flow than average. They rank 10th in market cap, $56 billion. A good amount behind Micron Technology, a small amount above NXP. Their price to book is between the median and average. We can't look at that PE since they have negative net income. Their price to free cash flow is worse than the median average. Same thing with the price to sales, worse than the median average. They generate more revenue than the median, less than the average. But they are growing. Their 5-year annual revenue growth rate is 19%, which is why the stock is inflated. To summarize, I have them trading at a 62% premium. They've been around 28 years. They are one of those mid-sized semiconductor companies people are looking at as possibly the next Nvidia, especially with AI, and if they could get a lot of business from that, it is possible the stock can 10, 20, 30x. Even though the stock seems overvalued, there's a decent chance it's going to keep going up. But at some point it will come down unless their revenue or earnings goes up dramatically over the next few quarters. I rank their free cash flows and revenue 5 out of 10 and their ratio is 3 out of 10. So let me know what you think. Give the video a like, subscribe, or comment below. If you want to be a member, you can click on the link in the description below. Thanks for watching.